All right, everybody. Welcome to the Rob Review. I'm your friend in success, Robert Morris. Very glad to have you on this series, this episode. Depending on how you're watching this, we're talking about two things in this series: how to buy stocks, and the next episode, how to find how to find stocks that you want to own, which is investments, long term, and then how to find stocks you want to trade. Two different things, two separate things, two very, very pillar things to building the foundation of your stock market success. Now, as I say, I'm your friend in success. Those of you that are returning, you understand why I say that. Those of you that are new, I say that because behind you, you see the undercredited investor. I, over the 3 years of teaching this stuff, have learned that I really, really love it, and I get a supercharge out of doing it because I believe everybody that's an entrepreneur out there, once you start making money in your business, should have a side business, a income stream built through the stock market, because I know that it is one of the best ways to build long-term wealth. And that's what principally brought me to start the Undercredited Investor, which is a newsletter that I'm releasing to the public now. Not just the audience, but the public at large can join for free. And I talk about all these things. I talk about my stock market system, the system that's not mine, but I learned from other people that are way more successful than me, but the system that I use. I talk about what I do, and weekly, right now at least, weekly, I put out a newsletter on Sundays that kind of sets up what I'm doing for the week and talks about a specific topic. One that I did just this week is, how do you buy stocks that you can be confident in owning in your portfolio with zero experience? Because there is no better way to get involved in the stock market than long-term ownership in companies. That's what the stock market is about. I'm just checking. I'm running my stuff today because I don't have all my team here. I am not one that believes in get rich quick in the stock market. And I believe there's a separate piece than just what everybody talks about. When people talk about trading systems, they talk about making money fast. I believe there's a place for that, but only if the biggest chunk of your money is going to go towards putting back into owning quality companies long term. Stock market success can only be long term if the majority of your money, especially in the beginning, is put towards ownership in quality companies that will pay you dividends and grow your money over time. And then once you get that established, you can come over here, and in the next episode we'll talk about trading short-term money, compounding that money so that you can put more money into funding your wealth account. Your wealth account, though, is built principally on quality companies. But what stops a lot of people is, how do I know what a quality company is? There's so much out there. It seems like no matter what happens, if the stock market goes up, companies go up. So why not just throw a dart on the wall and see what sticks? Well, first of all, that's because that's what a lot of money managers do. Second of all, you can do much better than everybody else if you understand this simple principle. Companies grow over time, not based upon stock market performance, but based upon quality products that are needed in a global demanding market. So, whether or not the stock market does well, the company that you buy into should do well. The share price is what you pay based upon stock market statistics and what the stock market says it's worth, but it's not always what the company is worth. And so that's where it differentiates, right? My belief is that you don't have to be an expert, especially in today's internet age, to take advantage of and know quality companies to buy. How do you do that with zero experience? You first say, I'm not going to overanalyze. I know that I may make a mistake in the beginning, but I know that if I take a couple of things away from this video, I can get started, and that's the most important thing. Analysis paralysis is the worst enemy to anybody becoming an investor, because if you even look at Buffett, the Oracle of Omaha, lots of his first investments were flops. but he learned from each one of them. And even the flops made him money that he was able to move forward with. So in my opinion, any investment is not a negative thing if you learn from it. But to get you started out in a, I think way above and beyond what most people will be able to do, I'm going to give you some insider tips that are really going to help you, all right? Now, you don't need anything other than the internet, Google, and a little bit of money that you're ready to invest to get this thing off the ground. That's all you need to start this strategy out, folks. So let's get started. Where do you get your information from? Well, I like people that are smarter than me doing my work for me. I don't know about you. And so instead of trying to be the guy that's the smartest one in the room, I just want to find people that have more to lose than I do if they're wrong. And I'm going to basically copy what they're doing. Now, granted, I don't just want one or two. I want a large pool to pull from so I can have my probability in the favor of I'm not just copying one person's paper, I'm copying the best of all. Because really, cheating the stock market is not cheating if you know what you're doing. Because the best people are all trying to steal each other's systems anyway. So here's my system for finding and buying quality companies. You start off with vetting, because all the funds out there in the world are ran by people that are either more intelligent than most people because they're plugged into Wall Street by way of information, or they are able to seem more intelligent because they have the right people whispering in their ear. So instead of just picking and choosing, I'm going to go and I'm going to Google search top performing funds of the past 2 years, no matter what year it is. 2024 right now, you're going to Google search that. You're going to pop up a search that's going to look like something, a list of different funds, because really it's advertisements, but that's okay because you can do your own looking and seeing how the funds performed. And if the fund returned 10 to 15, 20%, they're doing really good. Any less than that, they're still doing okay. You're going to look at those different searches, TD Rowe Price, Vanguard, and compare about 20 different funds. Now, I'm not talking about just any funds. I really am talking any fund that performs well. Large growth fund. They all name all their funds, these fancy names. But bottom line it for y'all, when you look at the top 10 holdings, a lot of them are similar or in similar sectors. And that's what you're going to look at. You're going to find, because it's regulated that they have to list their top 10 holdings in any fund, and you're just going to print out 20 funds, not really any more than that because you don't want to overwhelm yourself with work here. And you're going to look at, I like to look at them on a piece of paper and highlight. Every time I see a symbol that matches another symbol in a top fund's holding, highlight it. And then when I get done, generally what I see is that there are funds that they may not all be in the same order, but own specific stocks over and over and over and over and over again. And the more they own it, the more it goes up the top of my list. Until I have a list of however much money I have. So if I have $10,000, I might put 1,000 in 10 stocks, so I need 10. Or if I have just 1,000, I might put 1,000 in one, so I just need one, and I'm going to list them numerically. 1 to 10, the one that's listed the most across the board, number 1, 2, 3, 4, 5, all the way down. And then I got a list, right? That list is important because of this simple rule. Funds, mutual funds, cannot own more than a specific amount of a stock. And they would give every single limb they have to put the entire fund into those top 5 to 10 stocks. They want to be diversified. You want to be diversified, 12 to 15 well-chosen stocks, but they cannot own but so much. And so every time they buy more of a stock, guess what? They have to dig down the pile deeper, which is why funds don't outperform individuals, and they never will. But you, the retail investor, we can buy all we want as long as we have the money of common share stock. So, we're going to take that list, and we're not done. Once we get that list, we're really going to start the work now. That was the easy part. Now becomes a little bit more in-depth work. What you have to do is take that list and say, okay, out of all these stocks, what stock has the most global reach, has grown in price over the last 5 years? Because you don't want a stock that's so overpriced, i.e. Amazon before their stock split, that they don't have any more room to grow. But if it's a stock that's based upon their global reach and based upon a very specific word I'm going to use here, competitive advantage, meaning their product has a competitive advantage over everybody else in the entirety of their sector, i.e. Pepsi and Coca-Cola versus everybody else, i.e. Microsoft needs NVIDIA chips, so NVIDIA kind of has a real competitive advantage over any other computer, because no matter what computer you're buying, you can only really buy 2 different kinds of graphics chips, NVIDIA or AMD. And NVIDIA has a competitive advantage because they have better quality products when you do the research. So you got to do some research to figure out, does the company have a competitive advantage? And based upon where you live, your personal knowledge of the world around you, do you see the company continuing to be needed for the next 10 to 20 years? Example, where I live, John Deere has a competitive advantage over a lot of other tractor companies, all right? And they're going to be used in a farming community over the next 10 to 20 years. Even if they figure out how to have tractors run on AI by themselves, you're still going to have tractors doing the work. So that has a competitive advantage. Now, price-wise, I don't look at PE ratios and all that stuff. I just want to know, based upon the window of the company's growth, do I think it is overpriced? Based upon my personal money and how much I can buy. And does the company have a dividend? Because you want at least 2/3 of your holdings to be able to pay a dividend to you. Now, once you do all of that, you've probably narrowed down your list a good bit. The final piece of this puzzle to narrow down even more, if you do need to narrow it down even more, if you don't, then I would just move forward and wait for those companies to go through a downturn in their stock price. Usually August, September is a good time for that to set up. And then come out during November earnings with an upward move that you can buy into, or sometime during the November to January, February time period. It's not perfect. And you're going to move forward. And there is buying that you can do, and we can talk about later how I buy into these companies to make sure that I have the best entry possible. But right now we're just talking about choosing stocks, okay? Now, if you need to narrow it down more, you do need to go deeper on the competitive advantage side, because that is where you set yourself apart from everybody else, okay? There is something to be said for why particular people buy this railroad versus that railroad, and it's not always what the balance sheet says. That type of stuff does become a nuanced thing that you can learn over time how to see better and better and better. But for me, what I like to do if I'm really trying to narrow down, okay, do I want like Coca-Cola or Pepsi? Both have a competitive advantage. Which one do I think is going to grow more? Well, based upon my analysis of not just financial matters and balance sheet, but just growth, Coca-Cola is more worldwide. Pepsi is less known worldwide. It has more growth potential. And I like the taste better. And I know that Warren Buffett owns a lot of Coca-Cola. Therefore, I'm going to have to long-term deal with him owning a lot versus Pepsi. I don't know who the largest shareholder is, but I can know that at least there's more float. So maybe I choose Pepsi over Coke. that kind of thought process. It's not always so information overload type of research. Like for a lot of people, you're taught all your life that stock picking is a hard thing and that you need specific systems, and the people that are geniuses with software can develop systems that can allow you to take the emotions out of it and they can do the work. And some of that stuff does work gimmicky for a while. But truth, me and you talking right now, I believe that, yeah, my system may not be the best, but it allows for the average individual like me to be able to have a system that I can hone and get better at. And it's right here. And I can teach this to generations of my kids. And no matter their IQ, they will be able to choose quality companies to purchase. And it gives you the confidence to step into the arena and get going. Because once you're into the company, there's a whole lot more that you can do. And here's where the ending of this comes in, where the rubber meets the road at 16 minutes. The company is global. It's optionable. And the reason you want it to be optionable is so that when the company has long-term down slopes, downturns, movements that go weeks and months in decline, because every company does have that, you can use put options to offset your downside loss by buying, if you own 100 shares, you buy 200 shares of puts, or if you own 1,000 shares, you buy 1,100 or 1,200 shares of puts. That'd be 12 contracts of puts. And the downside profit generally will offset your downside loss, maybe even a little bit more of that actual ownership in that company. So that's why the optionable and the global perspective is important, because we live in a global world. And companies that have the ability to do business on a global scale, at least from a ownership and stock perspective, is better for you when you get started. The more money you make, the more you can get specific on buying companies that are more locally sourced. But right now we're talking large, building the foundation of your wealth account, and then adding the other pieces in later. Now, for those of you that are going to be watching the next episode, we're going to talk about how to choose stocks to trade once you have and are already into and have bought and have started your wealth account. I'll see y'all on the next one. I'm going to go over here and move on out of here and play this disclaimer, I believe.
Opinions expressed in this program or any other Rob Review program are not to be considered financial advice, and all these strategies have their own inherent risk. If you act on information given in this show, you are doing so at your own financial risk. Map.Productions does not take part in your positive or negative financial results. That is why I recommend you consult your financial advisor before acting on any of these tips. What worked for Robbie may not work for you exactly as shown in the show. The views and opinions expressed in this program or any other Rob Review program are not to be considered financial advice, and all these strategies have their own inherent risk. If you act on information given in this show, you are doing so at your own financial risk. Map.Productions does not take part in your positive or negative financial results. That is why I recommend you consult your financial advisor before acting on any of these tips. What worked for Robbie may not work for you exactly as shown in the show. The views